All right, it's a pleasure to call up our morning, our executive roundtable panel. Why don't you guys, I'd like to welcome up Josh Bailey from 61 Commodities and Marc Ostwald, please. Let's have a lot, yeah. And if I could encourage one of my colleagues to maybe bring a couple cups of water up here, I think we'd all appreciate it. That'd be great. Well, again, first of all, Ed, thank you for that presentation. I wish we had another hour and a half. I would have loved to listen to more detail, but we can talk about some of the stuff here. So works out perfectly. So it's a pleasure to welcome this panel, and thank you very much for being a part of it. With me, of course, we have Ed. We have Josh Bailey, who's the Chief Financial Officer at 61 Commodities, and our friend Marc Ostwald, who's the Chief Economist and Global Strategist from ADMI Services. So it's a pleasure to have you with us. For those of you who attend our European event, Marc is one of our frequent speakers there, and it's a pleasure to have him on this side of the Atlantic for this discussion. So yeah, let's kick things off, and maybe before this session we had a call with each other, kind of lined out some of the things we wanted to discuss, and one of the things that came up, and I think Marc, you had mentioned it. We often hear about uncertainty in markets, but you emphasized the deeper challenge of ambiguity. I was wondering if you might be able to unpack how ambiguity is shaping corporate decision making in the commodity sector.
I think the biggest challenge of ambiguity is you have two things with uncertainty. One is you still have to run your business at the end of the day. You can't put everything on hold, otherwise your business is basically going to shut down at some point. The ambiguity part relates both to this back and forth on what policies is the current U.S. administration going to put in place? Monday it's this, Tuesday it's this, Tuesday afternoon it's something else. And if you're a business and you're looking at your hiring plans, your investment plans, your product development plans, when you don't know what the legislation's going to be, how can you plan that far ahead? So it basically dampens everything in terms of employment and investment. But I think the other part of the ambiguity, and we're seeing it particularly in evidence at the start of this week, is we've had so many shocks over the last 5 years that we're now getting very abstruse reactions in the marketplace. Why, yesterday morning, did we have this rally in equities, even though the situation didn't appear to resolve itself? Why have markets gone to this sort of effectively looking through the Iran-Israel conflict to say, well, I can see how this works in the model terms, because what happens in the model is it has all those reactions that we've had over the past 5 years. They're so, in terms of tail risk, they're out in 0.1, if not worse. And the reactions thus far have not even been very close to that. So suddenly everyone says, well, it's not that bad, so we might as well look through it. So that's, those are two very challenging parts in terms of ambiguity.
Thank you for that. And by the way, anyone feel free to jump in with any other comments you might have on any of these answers. This is for I think the whole panel. Given the shifting geopolitical landscape and fragmentation of global influence, how are companies reassessing their trade relationships, particularly those have historically U.S.-centric trade relationships? Are we seeing any sort of meaningful pivot towards new regions like Africa and South America?
I think we're seeing much less of it than you would think, although the world has actually gotten accustomed to it in several respects. So as I mentioned in my talk, the Russian attack on Ukraine certainly has led to a fundamental change in trade flows. That fundamental change in trade flows is partly geopolitical by virtue of the sanctions imposed by countries on Russian crude imports and Russian product imports. Another change has been accelerated, and that's the change that occurred on the gas side when Russian gas exports were interrupted at a time when the U.S. is at a period of explosion of natural gas production and LNG takeaway capacity. So the U.S. has been able to replace a significant amount of gas in the market, but it's been an even more profound change in trade than that. So on the gas market, there was locked-in bilateral trade historically. The U.S. Legally doesn't allow for trade restrictions, so destination clauses are not allowed in U.S. export contracts. And that's meant that there was an acceleration with Russia-Ukraine of the U.S. becoming the supplier of last resort, but changing effectively bilateral arrangements across the planet for LNG trade between supplier and buyer. That's just a little bit of an answer to that question.
Excellent. And when you talk about explosive takeaway capacity, if you live near Freeport, literally it was explosive.
Yeah, we're historically about 12 BCF of export, and we're going to double that in the next 5 years. So I agree with Ed's point. While geopolitics are always changing, the fact is we are the top producer of natural gas. So we are going to continue that, and all the geopolitics kind of come and go.
Yeah, I think actually there are changing relationships, but can anyone, at the end of the day, particularly for those exporting to the US, change the fact that the US is still one of the major hubs, if not the major hub, outside, including China, for demand. That said, there are regions which have been growing very rapidly. I mean, particularly last year in terms of natural gas, you only had to look at Southeast Asia for enormous growth in demand. But that's not actually being triggered by anything other than the fact that those economies are the vibrant parts of the world's growth. I think the more important part is what the seizure of the Central Bank of Russia's assets did back in 2023 is it set this precedent, which Section 899 effectively of the tax and spending bill it also implies that where countries from the Middle East, from Asia, oligarchs or sovereign wealth funds previously parked their money in Europe and in the United States, they are now actually very fearful of what Ed was talking about, these political moves where basically something is deployed because we don't like you anymore. And that is creating enormous flows out of both Europe and particularly, but also the US, into other areas, above all, Southeast Asia, into Dubai and Abu Dhabi. And that obviously then has a knock-on effect of affecting financing ability, above all for trade.
Well, Ed did when Ed mentioned this in his talk. You noted that the tariffs are increasingly used as geopolitical tools rather than just economic levers. What advice can you give companies to? You said how can it be tamed, but what advice can you give companies to navigate this type of landscape? And I'm going to ask one of my friends here to bring me my little timekeeper there that I left on the table, so I know what we're doing. But I'll maybe start with you on that, Ed.
Yeah, so we've already seen some of what might happen to a larger degree. We don't know what will happen when we get to this new world of permanently higher tariffs. But we've seen on the selling side, the sellers, and this is true of China in particular, but they're not alone, not raising their prices to the level of the tariffs and trying to find ways to accommodate the consumer so they don't lose the consumer market. So this is a challenge for suppliers. It's accelerating the use of artificial intelligence, robotics on the manufacturing side. On the buying side, you have to swallow some of it in terms of profit margin. This is something that is going to be endemic to the world of higher tariffs because it will be an erosion of profitability, which has knock-on effects. But and then, of course, you have to seek out in a new world of tariffs where the lowest price source of whatever the goods are that you want.
But that's the challenge the Fed's in right now, because you have tariffs which are going to be inflationary, so they're going to be battling inflation, and then the economy is going to be pulling back. So tomorrow they'll likely announce they're keeping rates flat. There will be no more reduction, and we're going to be here in this world where how do you manage through this uncertainty? When you have these tariffs going on, how do you, with prices high, how do you manage that? And that's the challenge.
I think the other thing is, look how, we all know that the commodity and energy industry is amongst the most innovative when faced with sanctions, embargoes, tariffs, or some other tensions. There will always be a way through. Couple of good examples, EU trade with Russia. Yes, in nominal terms, if you look at the destination on the trade docket out of Germany, France, Italy, it says Kazakhstan, it says Uzbekistan, Tajikistan, and you've seen trade with those countries grow by 100, 200, 300, 400%. So ultimately, that trade with Russia is still going on. So that is the innovation. On the other hand, there's also been this very China, particularly, this creative use of alternative, source destinations. Thus, Vietnam trade between China now and Vietnam is bigger than both South Korea and Japan, which is really quite remarkable when one thinks of the two economies. And Mexico overtook China last year as the biggest trading partner of the United States, precisely because China was using Mexico as a connector country, and that's the other thing which happens a lot as a result of this.
Thank you. And you mentioned the business with Russia is still going on. I'm sure my friend Thomas from BIMCO will speak about this a bit more. One of my favorite phrases to come out of the last few years is shadow fleet or dark fleet. It's a big problem, but it's a real cool spy novel type of a word for it. So we're going to call up our first poll. This is actually a variation on on the poll we had a little earlier, but a little more detailed. And I'd love to see where where some of the other answers fall. So Dave, could you pull up our first poll, please? So what is your... That's the wrong session, Dave. No? Okay, we're going to move on to our polling. This is new technology for us. A lot of you have incorporated AI and all sorts of things into your businesses. We're working on our polling system. So with the U.S. now a top exporter of oil and gas, what does this mean for global energy market dynamics? And you got into this a bit in your talk. How do traditional players like Saudi Arabia and Russia respond to the shift? So maybe Ed, you can bring us in where you left off on your talk a bit.
Sure, and this is partly speculative, partly try to think through the dilemmas that producers have, particularly OPEC plus countries have. And yes, there may well be a dip in U.S. production for a year or two, depending on where prices are, depending on where innovation is, and this is a very phenomenally technologically advanced sector when we think about shale in the U.S. But they know that Alaska will be seeing a surge in production before the end of the Trump administration. They know that the likelihood is of another increase in Gulf of Mexico production. If they careful enough about their analysis, they know that U.S. demand is really sinking in its growth rate, and the U.S. too will, like China, reach peak demand, not as fast as China, but soon. So this might be the last effort of OPEC Plus to do what they're doing. What would happen? So if you look at Novak's speech about the study that was done in Russia, they discovered that if they manage to produce steadily without cutting production, which makes them lose production capacity, they can maintain 11.5 million a day until 2050. And they can sustain low prices because the ruble goes down with low prices, and their costs are insulated because they're ruble-based. So they can manage quite well in the world of the future. If you look at the Saudis or the UAE, they are trying to accelerate to the degree they can the diversification of their economies. They expect that they could be in a world where we'll have very significant volatility, larger than the day-to-day volatility we're having. But as supply and demand try to adjust to each other, both being longer-term processes, particularly on the supply side, we're going to see, maybe a $30 price range. How do they survive that? But that'll be the different world of the future. So I think we can kind of see that peeking through to the future, and I think we're seeing it in the calculations being made by both Saudi Arabia and Russia.
Excellent. Thank you. So let's move over to some other commodities. As electricity demand and metals intensity rise globally, especially driven by energy transition, how are these shifts reshaping the geopolitical investment landscape for critical minerals?
In terms of critical minerals, first of all, let's make sure that we understand what we mean by critical minerals. They're not something which are scarce. They are simply something where you don't control the supply chain, or one of your allies doesn't control the supply chain. Scarcity is not really actually a phenomenon at all.
You just need them.
You just need them,
yes.
Particularly in terms of battery metals. We're seeing it now. That's why there was so much emphasis on that at the most recent round of China-US trade talks in London. But in the longer run, what we're also seeing, and I think this is probably the point of emphasis, we're getting all this alternative renewable power sources, but belatedly, everyone's realized that their grids are absolutely unfit for purpose. That stretches from China through Europe to the USA. It's true all over the world. If we want to go to an electrified world, then we are going to have to do a lot more, maintenance of the infrastructure for the grids and upgrade it, also in technology terms. So there are enormous challenges. It's a huge investment opportunity at the same time, but it doesn't help when you've got such a volatile geopolitical backdrop.
Yeah, I'd like to add some things to whatever Marc said, and I agree with everything that he said. If we take a big picture of energy and world GDP, the oil intensity of the world has fallen dramatically. When I first started thinking about the world of oil, for every 1% increase in global GDP, there was about a 1.2% increase in oil demand. Prices rose with OPEC. Oil demand actually fell temporarily, but oil as a transportation fuel continued very robustly. But over time, since 1973 or 4 through today, the oil intensity of GDP for the world keeps going down. It's no longer anywhere near 1-to-1. It's closer to 0.3 to 1. And you can see it going into negative territory. Meanwhile, we're just seeing the beginning of the energy intensity of global GDP when it comes to electricity going up. And it's going up fairly dramatically with the electric needs of emerging markets, with AI, with cloud computing, and with military intelligence. And we can't underestimate what that's going to do to commodities. So if you take some things that are critical minerals, whether it's lithium or something more opaque, or you look at copper, the demand is going to skyrocket. The demand for aluminum is going to skyrocket. The geopolitics of it are going to emerge in an even worse way, I suspect, than the geopolitics of oil. And we're already seeing it with a concentration of focus on Africa, which is a source of many critical minerals. Cobalt in the Congo is something that people pay attention to. China has managed, Russia has managed to use either money or mercenaries to gain control of critical minerals. The U.S. is absolutely contemplating use of mercenaries, for lack of a better word, to oust the people who are in control to gain greater control. There is a significant element, not of the access to the minerals themselves, but to the processing of those minerals. Part of the U.S.-Saudi, U.S.-UAE tightening of relations is that those countries would be happy to do the processing. And they would do it in an economic alliance with companies from the United States. So we're seeing, I'd say, a major shift in the energy intensity of the planet and the geopolitics that go along with that.
That's heavy stuff. We experienced so much of that just from what the 40s onward in the Middle East. And it's interesting to think that that dynamic would set itself up over metals too. Josh, you mentioned that companies can't wait for stability. How are you approaching financing in a world where traditional trade finance players are retreating and new actors like crypto and insurance firms are stepping in?
No, and I mean, you heard Marc and Ed before talking about the volatility and all the uncertainty and what's going on. You think about what Ed just said regarding the need for these processing these minerals, and the demand is going to be there and the costs aren't coming down. And you have this, while the current administration has pushed back on ESG, the primary source of financing in this space is European-based. European-based banks are leading the commodity trade finance, and they all have ESG goals. You saw ABN exit, you saw BNP exit. So you're seeing the exiting of some of these banks. We'll see what happens. They're largely French and Dutch, et cetera. So what are the pushes on them to meet these ESG targets? So with those pushes and pulls, the question is you cannot wait. You need to find alternative financing, and that comes from many sources. Creating a relationship with insurance companies, using surety to do that. Negotiating with your counterparties. How can we create, we have one deal we're looking at right now where we're doing a prepay, where we will prepay for demand charge so that will allow them to get financing they need and give us access to manage that storage. And the other one that you see coming in is crypto. So you saw Tether announce, I think, $3 to $5 billion of financing in the commodity space. They acquired an agri company recently, so they've got a significant amount of capital. And how do they put that to use? And the commodity space is one of those areas. So I think the key to me, as I talk to our executive team, is while there's uncertainty, while there's volatility, you can't stand back. You heard Marc say in the beginning, you cannot wait, or else you'll get passed by. And from my seat, I need to make sure we have the capital to support this business and to make sure that we can grow and not be held back by that.
Thank you for that.
I think there's one other trend which is well worth mentioning. We're talking about a lot of these banks withdrawing from direct financing of trade. What they're actually doing in a lot of cases is simply de-risking, such that they don't want to have the end user risk on their books, but they're still actually providing finance. What they're doing is basically going to your Trafiguras, to your Glencores, to any of those other big commodity traders, say, you've got a XYZ billion line of credit from us, how about we double it and you provide the finance to the end user? The only problem with that is the margins that they will demand relative to the demands, how banks were pricing it, is far less attractive for particularly the small and medium-sized enterprises in the commodities sector than it was before. So on top of having a higher base level of interest rates, particularly in dollars, we've got an additional challenge that the margins are, from those who are willing now to supply trade finance, that are being demanded, are that much higher, and that is a significant challenge.
Yeah, that is the big challenge we have right now, which is it's very hard to be a new entrant in this space because getting bank financing is going to be challenging. Capital is more expensive. So you're going to see some folks squeezed out through acquisitions, through mergers. Like, it's just going to happen, and it's how do you make sure you are in a position to act when needed.
And you've spent a few years at banks, obviously. Any perspective on how banks are viewing the current environment?
Well, I'm thinking of banks and trading houses, and there are two unique things about the Trump administration, whether you like them or not. One was to set up a commission or a committee on energy dominance. But the other was to set up an advocacy center. And that advocacy center is enabling the government, whether it's the Department of Commerce, the Department of Defense, the State Department, the White House, to back companies, to select companies through this advocacy center, and to provide, if things work, EXIM financing, to provide guarantees on the credit side. And we'll see what the size of it will be. They're trying, certainly, to pull together budgets that had been in other departments, to pull them together within that advocacy center so that they can be as meaningful as European countries have been in dealing with trade finance.
I think saying two unique things about the Trump administration is a understatement, given the administration.
I also think it's what you were talking about, Exim Bank. It's interesting that they're actually drawing on something which has happened in Africa, where Western banks in general, whether it's European or US or Canadian, have for a long time been unwilling because of all the various risk, payment risk, supply risk, security of supply. And so what has happened is Africa has got innovative, thanks above all to Afrexim, in supplying finance for trade. So there's a lot of borrowing going on here, and the innovation, you really do just have to look around. I think it just emphasizes there are models in innovations for trade finance which are developing now.
Thank you for that. And we have our track tomorrow morning on trade finance. So particularly interested in this topic, please do join us tomorrow. I'm feeling a bit brave, and I think I'm going to try to ask Dave back there to try to pull up the second poll. Just give it a try. It's the one on how is your organization adapting its financing strategies? Can we give that one a go? I have a feeling he's going to have words with me after this session. Okay, we're going to just move on. We will sort this out over the break. So in an environment where risk is rising, but standing still is not an option, how should companies calibrate their appetite for risk while pursuing growth?
Yeah, I'll go first, sure. Yeah, look, you can't sit still. If you're going to wait for the volatility to end, I think when we were catching up for the planning call, this is the norm. Like, I think you said, companies are figuring out the reaction. I think it's almost numb. You overreact, and then everyone's like, oh, we overreacted to this. It's just Tuesday again. So we just have to move on. So you can't wait for the volatility to stop, or you'll never get anywhere. So the key is, how do you price the deals? How do you look at that? What's your cost of capital? How do you make sure that from a risk perspective, this is a deal that makes sense to you? And making sure that you understand all of the ins and outs is critical, but you can't wait for the market to settle down, or else you'll be left behind.
I think the biggest risk is, particularly in things like the power markets, is what it does is choke off financing for long-term PPA contracts, which is going to make things very difficult. But you basically then just need to reduce the duration of that and try and secure basically roll-on financing for that. And that's just a facet of the way things are at the moment. You need to deal with and just be ready when and if things calm down a bit, that you can then move on to securing the longer term finances, particularly for things like energy, because at the end of the day, pretty much any company in the world, doesn't matter whatever sector, its biggest cost outside of its staff is energy.
Just to add very briefly on those comments, a company cannot stand still, because doing what they've been doing will not work not only 10 years from now, but probably 2 years from now. And then the issue is, what are the risks? How do you calculate the risks of doing one thing versus another thing, independent of where the financing is? You see this in kind of an intriguing way in something that we haven't mentioned, namely the hydrogen market. Hydrogen looks very expensive. It looks very dicey from a technology perspective. But if you actually look at the hydrogen market, there is significantly more demand than there is supply. And there's significantly more demand for cleaner, whether it's blue or green, hydrogen is an open question, but the demand is there. So calculating, you need to make an investment. How do you make a modest investment in something that requires, at the end of the day, a significant investment? So it's a dilemma, but it's certainly on the plate.
Yeah, look, this uncertainty is creating opportunities. Like the folks are seeing this uncertainty and looking to exit certain businesses. So being there, our deal pipeline, I was talking to the BD team yesterday, our deal pipeline is bigger than it's ever been. So there is a lot of opportunity out there. So I would say it's not looking at it as risk, it's what are the opportunities and can you calculate that risk to make sure you're growing in a smart way?
Yeah, last year at the conference, one of the big topics was, I believe it was the rising interest rates. That was like the big topic du jour. And one of my friends, who I see in the audience today, mentioned that for every person to whom that's a negative, there's someone to whom that's a positive, and that's I guess a big part of that, right?
One other thing on that front, which I like to mention, because for a lot of companies, when they look at the choice of how do we go to alternative energy sources, what they tend to think of is what are people doing in my sector. So you're looking very focused on whether you're a restaurant, whether you're a hotel, or instead of looking at their geography and seeing which other companies who are operating in this area, in my geography, would have an interest in lowering their energy costs. And if we pull together, what can we do to invest in alternative sources to not take the hit completely on ourselves and also take the risk of basically going down an alternative energy source route and finding that some of the technology gets outdated?
Yeah, a lot of these data centers, to that point, are looking to create their own gen on there, whether that's renewable or whether that's battery, however they're trying to combine cycle. Like, they understand that that's their critical input. So how do they get that themselves?
And you're seeing a bit of it in the manufacturing sector. So the places that have had abundant, inexpensive energy are the older industrialized parts of the United States. Maybe starting in Pittsburgh or places even east, going through Iowa, where we've seen new sources of manufacturing investment based on where the cheap electricity already is.
Let's move over to supply chain a little bit. One of the things we discussed were some of the weaknesses in some thin supply chains, some stretched supply chains. So we mentioned from magnets to cocoa, supply chains are thin and increasingly politicized. We've been through a lot of this with COVID and with the Ukraine situation. Where do you see sort of the most, I guess, the biggest choke points today? I might stare at Marc for that one. That's
I think the biggest problem here is you've got a three-way challenge. One, most of the technology in the battery sector, the science hasn't, and the engineering hasn't got to a stable level where you can create a proper market. You're always worried that whatever you're doing is going to be superseded, and given technological development that we've got nowadays, it can literally, you make the decision, and 1 year later you find you poured your money down, well, not the toilet, but it's a bad investment. And so you were talking about copper and the more obscure things, lithium or yttrium or the biggest problem here is, in terms of the battery technology, in a lot of cases, we will get to the point where the scientists actually work out, actually we can use 10% of the amount of the copper that we were originally thinking of in this. So it's a matter of being, a lot of the time, not listening to fads, because a lot of it's not very educated in terms of the knowledge base, and that's part of the problem of information flows in our time. But being, making yourself aware of developments in this, and as things stabilize, then taking that opportunity, but finding ways in the meantime to gradually mobilize your overall long-term plan towards that sort of sector.
So let's talk about ESG for a second, because we've touched on it in a few of the different points, but obviously ESG is undergoing a shift. When I talk about past conferences, we had 2 years where that was the phrase used in almost every session we produced. It was ESG, and it's going from from sort of broad political slogans to hard metrics, but it's also getting entangled in politics. And how are executives navigating ESG in real terms when it really when it intersects with either trade finance or your customer demands?
Sure. Yeah, look, ESG is an interesting topic, right? And I think most of the time people are thinking about the environmental, there's the social and governance, but a lot of times it gets wrapped up into how do you deal with the environmental impact? And I guess for us as an energy merchant, it's something that we're talking, and I mentioned earlier, a lot of these commodity trade finance banks are European-based, and they have targets and goals that they're trying to achieve, so it's important for us. We're a private company, so we are not doing deals to put a ticker on the website to say how green we are. For us, it's when does it make sense? We've looked at deals. We have a relationship with the utilities who are looking for renewable natural gas. We've looked at other opportunities at wind assets and solar. And I think the key thing is, are they economical, and can you make money doing those activities? And for us, in the natural gas space, there's also opportunity. As you move to this world where renewables are more relied on, it's going to create significant volatility. You heard Ed, I believe it was, earlier talking about as you try to, make renewables a primary part of the grid, when the sun isn't there or the wind's not blowing, that's going to call on the gas or oil or, after Russia, Ukraine, and Germany, coal. And you call on those, and when you need those assets, when you need power, you need power. If it's really cold and grandma's at home and not getting any heat, you need to turn those powers on. So that's just going to cause an increase in price. And Marc was saying we're not spending money on the grid. There's a significant amount of upgrades that are needed. So you have this reliability issue where we're not spending money on the infrastructure for gas and oil. And when you need those assets, it's going to create a significant volatility in those markets.
The total brownout that we saw in Spain and Portugal has some salutary lessons. What I've read recently, actually, the people who, probably one of the most maligned power suppliers I can think of in the world, ERCOT, actually has found a way of managing some of the risks that have been highlighted by this intensification of power use, particularly in those ones where you have a more reliable power supply in terms of solar, in Spain and Portugal relative to, say, Northern Europe. But I think also what we've got is a sea change in terms of the pushback both in the US and above all in Europe. All those moves to right-wing, more right-wing governments in Europe has also seen a pushback there. Even the EU has started to water down some of the things to do with CBAM. And the EUDR above all. As someone said to me in Singapore at this equivalent conference, they said, well, actually, in many ways, this pushback is a good thing because now we can actually get to the situation where we look at the science, we look at the engineering, and most of all, we can consider those two in the context of, is this a commercial opportunity? And we don't need to basically pay too much attention or give too much respect to the political will.
I would just add to that that we were a little bit too ideological, not just across the planet, but even in the U.S., and that ideological position against fossil fuels didn't allow for a rational set of decisions on how do you get from here to there. It came to home, and I agree entirely with what Marc said, by the forgetting about the word affordability, particularly on the electricity side, which led to a lot of rebellion by consumers on this, but it's also led to coming back to sense on you can't get from here to there in terms of however you measure it, degrees of warming or other tangible measures. You can't get there without using more natural gas. And you can solve the credibility, the affordability problem also by using natural gas. So I think this is, in the longer term, we're taking a deep breath, we're making some steps backwards, but I think the setting is much better for a more accelerated development of what we used to call an energy transition.
Yeah, and I think, Marc, your point on ERCOT is a good example, and that's the one I think everyone always goes to. You see the volatility in the power market down there. You'll see prices go negative when the wind's blowing because they have production tax credits and other reasons that they'll produce when it's negative. Then as soon as the wind stops blowing, the prices spike. So I think that is what you're going to see. And natural gas is the transition fuel, but if you're not going to, MVP took, 6 years and was $3 billion over budget. Trying to get a new pipeline built right now to get that gas from the production areas to the demand zones is the challenge. So you're going to need you're going to need natural gas, but you're not supporting the infrastructure to get it there. So then you're in this place where, okay, so you're going to see significant volatility while you get through there.
Yeah, but on the infrastructure side, all of a sudden Williams is pro 2 pipelines, getting gas to where it couldn't go before into the northeast part of the country.
And you also, and this is true, also Calendar's challenge to decrease its reliance. A lot of the interstate laws in the United States basically need to be changed. Things like the Jones Act also need to be addressed. And in Canada, inter-province trade has so many trade barriers, it's absolutely ridiculous. They're their own worst enemy, and they create a lot of dependency on the U.S., not because of the U.S. demand, but because they've got such stupid interstate or inter-province laws.
That wasn't a strong statement at all. I've actually got only one. I got one more question, and I'm going to ask it, and I'm going to hold because I would love to take some questions from the audience at this point. And we have Amanda walking around with the microphone. The question I'm going to ask, and it's going to be our closing question, knowing that this is being recorded, and there's a guy with a camera back there. If we're having this panel again next year, what's the one headline issue you think we're going to be debating and why? But before you answer that, I'll give you some time to think about it. Let's go to the audience. Does anyone have any questions? There's one down here.
Where?
Right down here? Did you?
Thank you. Should I stand up?
You can if you like.
I'm Razdan from Quantum Horizon. So my question for any of the panelists is about depreciation of dollar against other floating currencies and the impact on the commodity prices. Because we see there is a consensus that the price of the commodity is going to go down, particularly oil. So brings back, is it in dollar going down? So in other currencies, how does it going to impact the countries who are exporting oil? Because a lot of times they buy their products what they bought from European countries or other sources.
It's such a complicated question, Amir. It's hard to know. You're asking a question of ultimately what is the role of the dollar in global trade finance, and nobody knows the answer to that. It's hard to dethrone it. From an emerging market perspective, the movement toward a lower dollar value is a boom to them because there are so many dollar-denominated commodities that it gets to be a lot cheaper. The world needs a structure to have efficient trade finance, to have an efficient reserve, whether it's a company or a bank, a central bank. And this is now really challenged in a way much bigger than anything we've seen since 1971, when the U.S. unilaterally went off the gold standard. And there's just no real answer for it. I think we have to expect that with a higher tariff environment, there's going to be much less trade than we've gotten accustomed to. With a higher tariff environment, there's likely to be a lower demand for dollars and a lower value for dollars. So I think that's going to stick with us for a while, and it may stick with us until we have a new government in the U.S. But getting trust back in the U.S. as the manner of the dollar, when it's used swift as an instrument of policy for foreign policy objectives, not for economic anything, is a really difficult setback.
Thank you.
I think the other challenge is where the dominance of the dollar is also the dominance of dollar debt in the world. And what most people can't do is suddenly shed all of those dollar liabilities, because what other currencies are, euro can offer some alternatives, but the depth and size of the market is paltry, particularly in offshore terms relative to the. So this may be a long-term trend in diminishing use of the dollar, but actually getting, the sort of, that's the end of the dollar, idea is actually one where, well, only if you want to accept a complete collapse in the global financial system, if one's going to be honest about it.
And it's not only Europe that doesn't want to replace the U.S. China absolutely does not want to replace the U.S. when it comes to the transaction use and the reserve use.
Thank you very much. Any other questions? All right, well, this is the time to be wrong, gentlemen. Let's, quick one-sentence answer. What will we be talking about this time next year? Who'd like to go first? Ed, you want to kick it off?
Sure. I'll say that there are two risks looming on the horizon, and I'll get to them in a minute. Aside from those two risks, if everything continues as it has, we'll be back here saying how wrong we were about being pessimistic about the world. The two risks that loom large globally have to do with a historical analysis, not with a contemporary analysis. And that is that when Putin leaves office, and he's not young, there's going to be a conflict internally about succession, a conflict internally about what's happening inside the country, and what's happening between that country and others. It's happened with every change of leadership in Russia since the early 1700s. It's not going to change now. The same is true, but not for as long a historical period, in China. And just think of the difference between Mao and Xi and what happened with the opening of the country, with the thinking that the company's wealth is dependent on a globalized market, dependent on China playing by the same rules as everyone else, having joined the WTO, which was created to accommodate China's growth and China's impact on the global trade system. And look at where we are now. So that's a political preference of a leader who came to power and who's going to leave power also in the shorter run rather than the longer run. So I'd say the world geopolitically is going to change as a result of that. I assume Trump will leave office by virtue of democracy prevailing. And we'll have...
He's not a young guy either.
He's not a young guy either. And we don't know in all of those three cases whether they'll be departing as a result of natural causes or not.
Great. Thanks, Marc.
I think we're going to be still talking about the dollar. Probably a lot of the narrative will still be as uninformed as it is at the moment. And I think the other big topic will be global debt problems, because they're only going to escalate over the next 6, 12, 18 months, and particularly the Japan problem hasn't gone away. And it was always at the forefront. We allowed it to just develop, and suddenly it's 260. Remember, everyone else, even Italy at its worst, was no worse than 180.
Josh?
Yeah, I think we'll be talking about the same thing. To try to think that anything's going to be stable under the current administration, when every day it just depends on what tweet our current president wants to send out or what tariffs he wants to try to use to leverage. You heard what Ed and Marc said, Ed, on the Russia and China. I think to think they're going to go out quietly into the night and not try to make their lasting mark, I think would be naive at best. So I think it's, we'll probably be having the same conversation.
And I'm going to close it by saying, since this is going to end up on our website in a digital format, that I, for one, welcome our AI robot overlords. And, I've been all for you guys all along. So, anyways, thank you, gentlemen. Let's have a round of applause for these folks. Ed, Marc, and Josh, really appreciate you taking part this morning.